You think things are bad now? We haven't even started to feel the true and real impacts inflation and this Fed's monetary policy will have on the real economy. If you were to take a look at your stock portfolio, you would think to yourself, things can't possibly get worse. There are some great companies that are down near or over 50% for the year. This includes companies like Amazon, Disney, Target, Nvidia, Google, and Tesla. The list can go on, but those are a couple companies that are down a ton this year. So how in the world can companies of that caliber continue to fall and drop by any significant amount? You would think that they have to be cheap at these current prices. Well, you'd be surprised, and unfortunately, you'd be wrong as well. They can, and they likely will, continue to drop even further. And that's because of
one fundamental principle,
which is the stock market typically does not bottom before a recession. The stock market typically bottoms during a recession. And right now, based on economic data, we are not currently in a recession.
I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market.
Things can and things will likely get much worse. So if you were to ask me what my personal opinion is, it's that we will be heading into a recession and it's likely to come in 2023. I feel very strongly about this. I have high conviction behind this call. And I also think the recession is going to be more severe than many people think. In this video, I will provide 3 compelling arguments that support that a recession is on its way in 2023. I'll even throw some data at the end to help determine when a potential stock market bottom might be and what you can be doing during this recession to capitalize on the opportunities that will present themselves. So let's get started.
Part 1, Economic Turmoil in Europe.
It was just announced by the UK Finance Minister Jeremy Hunt that the United Kingdom is officially in a recession.
They also judge that the UK, like other countries, is now in recession.
While the United States is not physically located in Europe and our economies are separate, they do, however, intermingle. Now, this does not mean that every time Europe enters into a recession, the United States has to as well. But if you look at history, a recession in both regions typically coincide. And a lot of the reasons why Europe is currently in a recession also apply to the United States. Some of those reasons include the central banks printing a ton of money during the pandemic, a shutdown of global trade due to overreaching lockdowns and fear mongering, which is all having an impact on the supply chain and inflation. You simply cannot expect the Federal Reserve of the United States to double the size of their balance sheet and increase the amount of money circulating in the economy by twofold in about 1 year's time and not expect high levels of sustained inflation and therefore the need to cause a recession in order to tame inflation. At some point, you have to pay the tax man. We could have and we should have paid it during the pandemic, asking people to hunker down and save their money and cut down on their expenses. But instead, we did the opposite. We printed a ton of money and we incentivized people to spend money and stimulate the economy instead. And we need to pay our dues. We need to pay the tax man, and he's coming to collect now. To make matters worse and increase inflationary pressures, supply chains are extremely vulnerable to an energy crisis in Europe, especially in Germany, which is the industrial powerhouse of Europe. Many industries and a huge portion of the supply chain rely on natural gas. Before the Ukraine war, Germany relied on one source for natural gas, and that source was Russia. There are 3 pipelines that supply natural gas from Russia to Germany. After the war started, 2 out of 3 of those pipelines were closed. On top of that, the last remaining pipeline was dialed back in capacity and often shut down periodically for quote unquote maintenance. All things said and done, Germany has a very tight supply of natural gas to get them through the winter. If the weather is harsh and reserves run low, the first thing Germany is going to do is they're going to cut back on manufacturing. Factories are going to close because they're going to have to focus those reserves on heating homes, hospitals, and areas of high importance. And this makes the supply chain extremely vulnerable, which could potentially lead to higher prices in Europe and also higher prices in the United States. And if supply is damaged, then the only way to tackle inflation is to destruct demand. And the only way you can do that is through a severe recession.
Part 2. Monetary policy at the Federal Reserve.
The goal of the Federal Reserve is simple. They want inflation to drop at 2%. Which is a long ways down from where we are currently at. This goal has been stated time and time again by the chair of the Federal Reserve, Jerome Powell. Not only has he made this goal clear, he has also made it clear that rates are likely to go higher than expected, to stay higher for longer, and most importantly, the risk of sustained inflation far outweigh the risk of a recession. He has even gone so far as to say, expect pain.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
This stock market suffers from short-term memory loss and fails to realize the lag effect of monetary policy and the impacts this policy will have on corporate earnings, stock valuations, and the real economy. This market currently trades at a price to earnings multiple of around 20. To put that into perspective, that's about average for the stock market. During times of recessions, the price to earnings multiple can be far less than 20. You can easily see that multiple drop to 15 or even lower, which would imply that we have more than a 25% drop from the current prices just to get to that multiple. And that's assuming that earnings would stay flat, which in a recession is very unlikely. So to account for the potential earnings drop, stocks would have to drop even further to get to a 15 price to earnings multiple. It's a double whammy. You have multiple compression and you also have earnings decline. This would imply that stocks still have a ton of risk to the downside.
Part 3. Signals from the bond market.
The yield curve has been a great tool in the past to predict recessions. There are certain tools from the bond market that investors should and can use to help position themselves for upcoming recessions. The most common signal and the most talked about is the inversion between the 2-year treasury and the 10-year treasury. This spread has been inverted for quite some time now, signaling that a recession is on its way. But the spread between the 2 and 10-year isn't the best signal. And if you want to see a crazy inversion right now that is just screaming a recession is on its way, look at the shortest term rate out there, which is the federal fund rate. It's an overnight rate. And compare that to the current yield on the 10-year. If you look at the data, you can see that we're currently inverted in what the Federal Reserve is willing to pay you overnight versus what you would get for buying a 10-year treasury. Let that sink in. You can get a higher return with much higher liquidity because your money's only locked overnight than you would get from buying a 10-year treasury, potentially locking your money up for 10 years. This inversion screams that a recession is on its way.
Part 4. What to do.
So I don't know. Let me know in the comment section down below if you think a recession is on its way. But assuming that you do, what are some of the things that you can be doing right now? And what's a signal of a potential stock market bottom? Well, the obvious answer to things that you should be doing right now is you should try to save as much money as possible because cash is king during a recession. You can listen to Jeff Bezos and avoid buying those big ticket items during this holiday season?
Take some risk off the table. If you were going to make a purchase, maybe slow down that purchase a little bit.
You could and should cut down on your expenses. Maybe you reduce on the amount of streaming services you have. Maybe you eat out less, and maybe you order less Starbucks coffee. You could and should try to work more to make some more money. If your job does not allow you to do this, then you can look for some side hustles, some side gigs to make some extra money to try to build up your capital reserves. The goal is to try to build up as much money as you can so that when opportunities present themselves in a recession, you have the money there available so that you can jump in on those opportunities. In the meantime, while you're saving and building up money, you should do your research to try to identify those opportunities before they even present themselves. You should try to identify what prices you're willing to pay for a certain asset, because I can almost guarantee that when the time comes, things are going to seem extremely dire and you're going to be afraid to pull the trigger. Now, what's a potential signal to look for to indicate that we're near a stock market bottom? But one signal that you want to look at is the rate of unemployment. And this is because stock markets typically bottom after a spike in unemployment. And this is because at that point, we are then in a recession, and the stock market can begin to figure out when we're going to get out of that recession and start to price that into the market, which would help form a bottom. So after you see a spike in unemployment and you kind of see that spike stalling out and forming a peak, that is usually around the time the stock market bottoms. And if you look at unemployment rates right now, we haven't seen that spike. So we're still waiting for that data to come our way. We're still waiting for monetary policy to hit earnings and cause a recession before we can see a stock market bottom. Now that about wraps it up for this video. If you want to support this channel, you can join the Patreon. It will also give you access to a private Discord server. It's a community where we learn together and grow together. In that Discord server, I also notify all members of every single trade that I enter into. These are swing trades, and I also notify all members of investments. The swing trades right now have been extremely profitable. Here are some examples over the last couple of months. A link is provided in the video description. It's only $5 a month to join, super cheap, cheaper than a Starbucks coffee, and it's a service focused on investing and focused on making you money. I'll leave it at that. It's been real, it's been fun, it's been real fun. And this is We Are Investing, and together we are invincible. See ya.